Over the next 12 months, SoFi has an incredible growth opportunity. And with their earnings coming up here in just a couple of weeks, what we are going to discuss in this video is what SoFi is expected to announce in their earnings, as well as a recent interview from the CEO, Anthony Noto, and dive into what he discusses and how it could affect SoFi's business in the long term. So let's go ahead and jump right into it. SoFi is expected to announce their earnings before the market opens on July 29th. And analysts are expecting EPS to be up around 300% year over year to 6 cents per share. That is up from 2 cents per share a year ago. EPS of 6 cents per share is definitely achievable, but what's a little bit more aggressive is where analysts are expecting revenue to come in at. They're expecting 34% growth year over year from around $600 million a year ago to now bringing in around $802 million in this current quarter. And the reason I say this revenue target is a little bit aggressive is because SoFi provided their own Q2 guidance during their last earnings report, and they projected that they would bring in revenue between $785 million and $805 million. The midpoint of these two estimates is $795 million or 33% growth year over year. So analysts are already expecting the company to come in and beat their own guidance. So for SoFi to move up after this announcement, they need to come in, not only beat their own guidance that they provided during Q1, but they also need to beat the guidance of analysts. So the best way for SoFi to continue this upward momentum that we have seen in the stock is they need to come through with double beats. They need to beat on their bottom line numbers as well as their top line numbers. And one of the ways they are targeting to do this is by continuing to innovate their platform. And here's Anthony Noto, the CEO of SoFi, talking about some of those innovations.
Your stock has been absolutely on a tear and got a pop from the news that you're expanding to private markets investing. Stock was up 7% on this. How big of an opportunity is this for SoFi?
We think it's a large opportunity. It's part of our overall strategy to be a one-stop shop for all your financial services needs. Investing is one of those areas, and we're giving access to Main Street investors to products they would not otherwise get in prior history. So we started with single stocks, launched fractional shares, added ETFs, robo accounts. We then started doing IPOs. We were the exclusive retail provider of the Rivian IPO, as an example. And then about a year ago, we launched alternative assets, including private equity, private credit, private real estate, and then even an opportunity to invest in some private companies, specifically through SPVs like Anthropic as well as SpaceX. And this is an evolution of now being able to invest in private companies through funds. And you can invest with as little as $10. The minimums are all different, but and one of them it's $10, one is about $500, and one is about $2,500.
So what Anthony Noto is actually talking about there is offering retail investors the ability to invest in alternative asset classes. A very recent example of this comes from Robinhood and them actually offering a tokenized version of OpenAI stock. OpenAI is a private company and retail investors are not able to invest into it. So Robinhood actually took some of this private capital that they have invested into OpenAI and are now offering it on their platform in a tokenized version for investors to buy into. And SoFi is looking to get into the same market. This is not going to make a big business impact because overall SoFi Invest is a small piece of their pie. However, it will get people into their ecosystem and using a lot more of their products. In my opinion, something that is a larger opportunity for SoFi over the next year is their lending business. And here's some comments from Anthony Noto around that side of the company.
What's seen as another potential tailwind for SoFi is the idea that the new Trump bill could cap federal borrowing for college and grad school, which could drive more business to SoFi. What are you expecting in terms of growth because of that?
There will be a large opportunity for us to continue to leverage student loans, and the new bill will provide a bigger opportunity for us. But it's a much smaller piece of our business now. More than 50% of our business is from non-lending revenue streams. We've really kind of de-risked the balance sheet and tried to become more capital light. We've had 13 consecutive quarters of greater than the rule of 40, which is your revenue growth plus your EBITDA margin. And someone pointed that out to me. And our guidance for the second quarter will actually be the 14th consecutive quarter if we achieve it. and we have great momentum in the business. So while we're excited about the student loan opportunity, it's small relative to everything else that we're doing. That's driving the growth of our business and the Rule of 40 success.
In my opinion, there, Anthony Noto kind of discounts the impact that lending could have on the overall business. Yes, they are specifically talking about student loans, and this does make up a smaller portion of their lending business. But overall, in the last couple of years, they have seen their student loans actually double, and they are now sitting at all-time highs for their student loan originations in the first quarter. On top of that, we are seeing a solid continued uptrend in their personal loan business. That has set record highs as well for the first quarter. But what I think is the most interesting opportunity over the next year for SoFi is their home loans. Home loans is still at a lower point than it was in 2021. If we see interest rates start to drop, I would expect that we will see this start to take off in a major way, because anyone over the last 3 years who has taken out a home loan could potentially look to refinance with SoFi. But not only will this increase in loan origination help SoFi's top line numbers, they should also see a bigger impact on their bottom line. And that is mainly driven by the fact that they have shifted their business to being a little bit more focused on fee-based revenue. That means that they actually originate these loans and then they pass them off to another company and they collect a fee for that origination. And this should ultimately have a bigger impact on their bottom line EPS numbers. However, for SoFi to truly capitalize on this market, they need to continue showing strong member growth. Over the last 5 years, they have been able to grow their members at a compound annual growth rate of 52%. And right now, the company is sitting at around 11 million members. So we need to see in this second quarter, this trend of strong member growth continue, especially because right now, SoFi is trading at a little bit of a lofty valuation. Their trailing P ratio is sitting at a 50.72, while their forward P ratio is trading at a 74.07. This is a little bit on the higher end to where I would be comfortable for SoFi. In my opinion, I think that a 50 to a 60 forward P ratio is probably reasonable right now for SoFi as a business, but we will get into that a little bit more in a minute. Before we jump a little bit deeper into their valuation, I want to take a look and draw your attention to their EPS numbers. In 2025, analysts are expecting the company to put up 28 cents of EPS. In 2026, they're expecting that to grow to 46 cents of EPS. If we look at growth year over year from 2024 to 2025, that is about 86% growth in their bottom line, and then 64% growth from 2025 to 2026. So on a 1-year basis, right now, SoFi is trading at a PEG ratio a little below a 1. However, over the next 2 years, that PEG ratio starts creeping up to above a 1. As a general benchmark, a PEG ratio of around 1 is reasonable for a company. So looking at that and SoFi's growth projections over the next couple of years, it seems to be at a reasonable price. However, if you just look at PE ratio, what the benchmark is that companies can't really outgrow a 60 forward PE. What that means that right now, if we assume that SoFi should be trading anywhere around a 50 to a 60 PE ratio based off their guidance over the next year for their bottom line numbers, that means that the stock should be somewhere between $13 to $19 per share. That's a fairly wide range, but it really just depends on your EPS estimates over the course of the next year. I think that SoFi should honestly come in between that 28 to 32 cents per share. So I think that right now, $19 is probably reasonable for the company, especially with the amount of growth that we could see. But the other factor that really isn't accounted for in these numbers is if SoFi continues to shift their business to more fee-based revenue, we should actually see their profitability increase in a more substantial way than what analysts are currently projecting. Let's just say over the course of the next year, we see interest rates drop in a substantial way, and SoFi does a great job of bringing on new members and capitalizing on fee-based revenue. I think in that scenario, we could see the company put up anywhere between 45 and 55 cents of EPS. In this scenario, that would result in a stock price keeping the PE ratio again between 50 and 60 of anywhere between $20 $22 and $33 per share. In my opinion, if you are buying SoFi at these current price levels, that is really what you are banking on. You're banking on good economic conditions for SoFi to be able to capitalize on their lending business. Right now, I do own SoFi shares in my YouTube portfolio, and this is that portfolio, and it's currently sitting at a value of just over $71,000. And right now, SoFi is the fifth largest position in this portfolio. We have 200 shares of the company. Right now, the market value is around $4,300, and we are up over 260% on this position. And the only larger positions in this portfolio than SoFi are Microsoft, AMD, Super Microcomputer, and Google. We also hold United Healthcare Group. I could easily see this position growing to a larger position than SoFi. Right now, we are down around 6.5% on United Healthcare Group. We also have Adobe, PayPal, Abercrombie and Fitch, Alibaba, United States Lime and Mineral, Oscar Health, Estee Lauder, Zeta, and Hawkins. And overall, there are three main companies that I am paying attention to in the market. The first is the one I mentioned earlier, United Healthcare Group. To me, this is an easy buy. The stock is trading at $282 per share. Just a few months ago, it was trading at $600 per share, and insiders continue to buy this company. I think that right now, you're getting it at a steal of a price, and a year from now, I think that will reflect easily in the numbers. So I could see myself again adding more to that position. Another one is Oscar Health. Right now, I'm down around 5.5%. All their metrics are trending in the right direction, but the company's stock price continues to head down. This is one I could easily see myself doubling or even tripling the size of my current position. And then the last one is Zeta. Zeta, I'm only up very slightly on, and this is a newer position as well that I could see myself building out a little bit more. But of course, don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. Let me know in the comment section, do you own any of the same companies that I own? And what are your thoughts on SoFi? Where do you think the company is going to be trading a year from now? I personally think somewhere around that $25 per share. I think we've seen a huge run up. I could see the stock kind of cooling off for just a little bit, trading sideways over the next year or so, and then building up momentum for another big run, potentially in 2027. But again, let me know your thoughts down below. Thank you guys so much for watching. And if you haven't yet subscribed, subscribe down below and drop a like. And as always, have a wonderful rest of your day.